This is Kurt Heisinger, accounting professor at Sierra College and author of Managerial Accounting. We talked in a separate video about the distinction between manufacturing costs and non-manufacturing costs, and in this video we're going to discuss how manufacturing costs are recorded using three different inventory accounts and then the cost of goods sold account. So we'll start here by looking at the three inventory accounts that are used by production companies. The first account is the raw materials inventory account, and this account is used to record the cost of materials that have not yet been put into production. In a separate video, I talked about using an example of building custom high-end racing bikes. In that example, the raw materials inventory would contain things like the wheels for the bikes, the seats for the bikes, the frames for the bikes, the chains for the bikes. Those are all the materials that are sitting in the raw materials inventory warehouse but haven't yet been put into production. So the cost of those materials reside in the raw materials inventory account. The second account is work in process inventory. And work in process inventory is used to record the cost of products that are in production but they're not yet complete. Recall from a previous video that product cost, when we talk about product costs, include direct materials, direct labor, and manufacturing overhead. And all of those costs usually go into work in process inventory and are included in there while we are producing the product. But remember, the product's not yet complete, so we just include those costs and record those costs in work in process inventory until the products are completed. Which takes us to the third inventory account called finished goods inventory. And finished goods inventory is used to record the product costs of completed products. These are products that are ready to sell. They're fully completed. Back to our example of racing bikes. This would be where we've got the bikes completed, they're ready to go, everything is done, and now we simply need to find a buyer. The product costs related to those completed bicycles, direct materials, direct labor, and manufacturing overhead, would be included in finished goods inventory and moved out of there only when we sell the bike. In a manufacturing setting, once we sell our products, the cost associated with those products, the product costs, direct materials, direct labor, and manufacturing overhead, are transferred, I'm going to go to the second bullet point here, are transferred from finished goods inventory to cost of goods sold. So the focus of this slide is to talk about cost of goods sold and the cost of goods sold account. So the cost of goods sold account is an expense account, and it's used to account for the product costs related to the goods that we've produced that have been sold to customers. Once we sell the goods, the costs associated with those goods are moved from finished goods inventory over to cost of goods sold. And of course, cost of goods sold are presented on the income statement. Cost of goods sold account is an expense account, so it does appear on the income statement. Here's a summary of the accounts used to record product costs, and really this is the chronological order in which we typically use these accounts. So we start with raw materials inventory, and that account contains the cost of any materials that have not yet been put into production but eventually will be used in production. And this account, raw materials inventory, appears in the balance sheet as an asset. Then we have work in process inventory, and this account includes typically direct materials, direct labor, and manufacturing overhead associated with products that are in process. We haven't yet completed those products. So perhaps we're working on racing bikes and we've got several different bikes that are partially assembled but not yet complete. So the cost of those products would be included in work in process inventory, and then ultimately at the end of the period, work in process inventory appears on the balance sheet. The third account we have is finished goods inventory, and this is when we have products that are complete and direct materials, direct labor, and manufacturing overhead costs associated with those products are sitting in this account, and this account again appears on the balance sheet as an asset. Lastly, we have cost of goods sold. And this account includes all the costs related to producing our goods, direct materials, direct labor, manufacturing overhead. And this account appears on the income statement. It's an expense account. So in the end, when our products are sold, all of the product costs associated with those products that are sold appear in cost of goods sold on the income statement.